All right, we are going to jump in. We have a lot to cover today. So we'll go through our brief intro and then I will introduce Avneet today. All right, so welcome everyone. Today we are covering inside the QofE, what buyers really need to know about the numbers. We're joined today with Avneet Sekun. I hope I'm saying your last name right. And he is a director of M&A at TreeWalk. So I'll jump into his intro just momentarily, but a few updates on Village Wealth. You are joining us for our Friday speaker series. My name is Liz McCrae. I'm a co-founder and president of Village Wealth, if you are new to us. We are a deal management platform that was exclusively built to support buyers exploring ETA and navigating their search process. We have a marketplace with over 60,000 listings with AI matching that will generate suggestive listings to match your search criteria. We have a deal management dashboard component, AI analysis, and deal structure calculator and financing calculators built in that help you structure your offer in a way that the banks are going to approve it, whether that be for senior debt or SBA lending. We also offer a suite of business acquisition services. So we have a virtual community, we do debt advisory, we have search services, and provide full service acquisition advisory from start all the way through to closing. We do open office hours every Friday at 9 a.m. Mountain Standard Time, and this is our speaker series, one of the sessions you're joining us for. The open office hours are included in the premium subscription. It's our monthly subscription. We partner with ETA incubators and communities, lenders, investors, business brokers, and M&A advisors. So if you find yourself in one of these categories, please feel free to reach out and let us know if you'd like to work together. For anyone who has not tried our software platform, we do offer a 2-week free trial. So you can just visit us at villagewealth.com. That is WELLTH, spelled that way on purpose. And you can jump in and take a spin of the software and sign up for the free trial and access everything there. And that also gives you access to the Friday open office hours. So please feel free to jump in and introduce yourself in the chat. Let us know where you're joining from, what role you play in ETA. If you're an advisor or if you're a searcher, please let us know. I'm going to introduce Avneet here in a moment, and the format today is a full Q&A. So if you've been with us before, you know that sometimes we do a brief presentation. This session is going to be 100% Q of A. So I'm going to kick us off and get things rolling, but please ask your questions as we go. Feel free to add an extension question onto one of mine, and then we'll get into the nuts and bolts of the QofE today. But this time is also yours. It's your time to get your questions answered, so don't let me steal the show. All right, and with that, I'll introduce Avneet, who is joining us from Vancouver, British Columbia today, but they work both in the US and in Canada. So it's lovely to have someone today who works both sides of the border. Avneet is a CPA and the director of M&A at TreeWalk, where he leads the firm's transaction advisory practice. Over 5 years at TreeWalk and with roots at Deloitte, Avneet has built one of the most respected quality of earnings practices in the SMB deal community, completing hundreds of QofE engagements across acquisitions in the $1 to $15 million revenue range. He's known in the ETA space for translating complex accounting into the language buyers actually use, surfacing the add-back sellers can't defend, the working capital traps, the customer concentration risks that deal books tend to bury. Avneet is a regular speaker at ETA events, including the Texas ETA Summit and Search Fund Coalition panels, and is often the first call for buyers who need a clear read on a target before they sign the LOI. Today, he's here to pull back the curtain on what's actually inside a QofE report and what every acquisition entrepreneur should be looking for. So again, thank you, Avneet, for being here with us today. And we're going to start off with a really, really simple, basic question for those who might be new to the space, but kick us off with, what is a QofE?
Yeah, appreciate the introduction, Liz. It's a pleasure to be here, and it's a pleasure to meet everybody. A QofE. So I think definitionally, QofE, quality of earnings. Most people have heard that if they're in the ETA space or kind of know what it relates to. Financial due diligence, QofEs, all interchangeable. The one thing I always tell people is there is no set standard for a QofE. It's interchangeable with financial due diligence, but especially in the SMB and ETA and lower mid-market space, people call a proof of cash a QofE, people call a full-blown actual QofE a QofE, and everything in the middle and everything in between. So I think when they're in the ETA and lower mid-market space, the first thing I'm going to caveat and say is be weary when someone says QofE and understand what they mean by it. Because what a quality of earnings should be is a financial due diligence engagement post LOI done by a professional who does a lot of them and understands what they're looking for. And really, what it is it's a way for a buyer to get confidence over the financial earnings of a company and the integrity of the accounting system. And so I use that as a bit of a broad definition because the quality of earnings is at the end of the day a fluctuating engagement. And what I mean by that is we tailor our QofEs across the board to the risk areas of a particular business. So, for example, for a construction business, I care about WIP way more than I would care about that in another business, for example. If we're doing a business that is heavy on the inventory side, all of a sudden, I think in the lower mid market, about half or more of the businesses do their inventory and they're costing wrong. So, really, a quality of earnings is a engagement done post LOI to ensure that the EBITDA that you're buying, the working capital that you're buying, and the business that you're buying is as presented. And if not as presented, you know that going into that close that, hey, maybe the EBITDA was off a little bit, the working capital was off a little bit, but this is the business that I'm buying, and these are the results of our QofE. So really, it's a broad definition term, but at the end of the day, to simplify it, it's a financial due diligence engagement where we go in as professionals. Usually takes about 3 weeks, depending on the deal. Could be quicker, could be longer, depending on how quickly we get the information from the seller, how accurate the information is, etc. But at the end of the day, it's a financial due diligence engagement where we go through a set of procedures to ensure the EBITDA and the business is as presented.
So, in other words, you're essentially validating and verifying the information that's been provided by the seller.
Absolutely. And I think that's the quantitative aspect of the QofE. And one thing I always tell people, and it's a little bit of surprise to people that don't do it, is I think the qualitative and the narrative around the information is just as valuable as the quantitative. So I never complete a QofE engagement, or I never like to, without actually speaking to the seller first, right? Probably 3 days into the engagement, I love those seller and management calls where we go through maybe an hour of questions and we listen to the seller talk, and we listen to understand how they built their business, how they do their accounting, how they do their operations, and from there we tie that into what we're seeing on the quantitative side of the numbers and making sure the story makes sense, the story matches, and if the numbers are as presented, are there risks associated with those numbers based on the qualitative. So
Mhm.
really, it's a wholesome and a holistic engagement with both the quantitative numbers and the qualitative narratives of how the business is run.
Thanks for that. There's a question already in the chat from
Yeah.
Ryan, and I like this one too. How do you get the sellers comfortable with the QV process? You, in most cases, hired by the purchaser, and so here you are going into a meeting with the seller. How are you warming them
Yeah.
up?
And I think that's an amazing question. I love that question because in the lower mid market, that question is a lot more important than it is in the mid market. If you're doing mid market transactions, everyone expects the QV, seller expects it, buyer expects it, brokers, investment banks, they all know it's coming. Lower mid market ETA, a lot of times the broker will say, maybe you don't need one. Seller's like, no, you don't need ones. You get those whispers in your ear. The thing about the QV in the lower mid market when you hire the correct provider is we go in there and we talk to the seller without coming across as being that questioning or saying, oh, you guys did this wrong, etc. It's more of a conversation. It's more about getting uncomfortable. When we started doing QVs in the ETA space years ago, the first thing I always like to do, and this is kind of when I talked about getting on the phone with the seller, I love building that rapport with the seller early because a lot of these folks, they're not they're not intentionally manipulating earnings. They're not overstating EBITDA on purpose. A lot of it is just not understanding accounting and being in the lower mid market. They're focused on running the business. They're not focused on their books as closely as they should be. They're doing cash accounting. So really, sellers, I think, are open to having a QofE done as long as they understand how it's going to be done and to the extent it's going to be done. What they don't want is, honestly, you hire a QofE provider that's going to have 8 people on a call and run them through 7 meetings and ask them for 150 DD requests because they're not going to want that. So you need to have a QofE provider that knows how much to ask for, when to push and when not to push, and what areas can we get comfortable around with the information we have. So really with the sellers, it's early enough and it's getting out there early and saying, listen, I'm just doing this to protect myself, protect the deal, making sure that the numbers are as presented. And you guys talk to my QofE provider, they'll tell you that they're not going to make this a rigorous process for you. Obviously, there's going to be some lift for the seller, but we do everything in our power to make sure that we're only bothering the seller and their team for stuff we really need and not stuff that's just like check boxes or anything that's overbearing for them on running the business. Because the worst thing I'll tell you is when we do a QofE, the sellers focus on the QofE, sellers focus on legal, and now the business earnings start to drop. Now all of a sudden the buyer gets scared. So it's you have to really tiptoe those lines and make sure that the seller can still focus on running the business and be involved in the day to day, and you're not overbearing them with DD requests.
Well, and there's that risk of coming on too hot and heavy um and having them shut down as well.
Absolutely. And you know what? I'll tell you a story. Maybe 3 years ago, maybe 4 years ago, we did a QofE, and I sent a DD request list, labeled everything by high priority, and the seller calls me from his truck on the way to a job site. He's like, "Okay, so what do you need again? General ledger?" And I was like, "Okay, do you want me to like?" That's when I sort of realized, like, hey, we got to start to really draw their attention to a few areas, and we cannot send them something that's got 30 things because they're just not going to read it.
Yeah, absolutely. Abby's wondering the difference between QofE and financial due diligence. Is QofE part of a broader financial due diligence process?
Yeah, sorry, I think you cut out there for me a little bit, Liz. I think was the question around
Can you explain the
QofE
difference
and financial
between
due
QofE
diligence,
and
what the
financial
difference
due
was?
diligence? Yep. Yep. If you can see the
Yeah,
chat there
they're
too.
the same thing, interchangeable. There's no difference. Yeah. So the QofE is part of financial due diligence, but in the lower mid market, it's used interchangeably. When someone says they're doing financial due diligence, they're doing a QofE and vice versa. I wouldn't say there's any difference from QofE. In fact, we call our full financial due diligence package a QofE. Again, this is where I talked about at the start, is make sure when someone says that they're doing a QofE for you, or if you're hiring a different firm or somebody, that it really is the full financial due diligence and not just I'm tying out the bank statements. I did a QofE. That's not a QofE, right? So I think understanding what providers mean, but for us and for a lot of the major providers in the space, the QofE and financial due diligence cover the exact same thing.
Fantastic. And so Douglas is asking here, in your experience, to what degree do the results of the Q&E process impact a given deal structure, particularly the price and terms? And you mentioned that usually you're doing your QofE after an LOI. So essentially the deal has already been structured. And so how does that impact deal structure?
Yeah, you never want to go into the process expecting a retrade or wanting that really. At the end of the day, when people say, for us as a provider, we don't want to do that and we don't want to recommend the buyer do that, but it does happen. And if I were to give you a percentage, maybe 15 to 20% of the time, maybe 15 for actual retrades. And the reason is it's just the earnings are not what they say they are. There's uncovered customer concentration risks. There's stuff around working capital that wasn't uh, really, honestly, when you go into LOI, you're not going to know what the working capital of the business is and what the need is at that stage. So that's why you get the QofE. And now all of a sudden we tell you the working capital is this. All of a sudden we convert the books from cash to accrual, and now they have this huge deferred revenue component that's increased EBITDA more than it should be. So really, it does impact the deal structure. No one loves to have that conversation, and that's not our goal. But the reality is once you do a QofE, there is a chance, and it's not small chance, and it's not a, I guess, it's not a scenario that doesn't happen. It does happen frequently. It's not always, but there is a chance that your deal is going to retrade.
What percentage of deals do you guys typically see retrade when you've done a QofE?
Yeah, like without having the numbers in front of me, I would say 15 to 20% probably.
Okay, I expected that to
Yeah.
be higher, so
Yeah.
that's good.
Yeah. I mean, those are the retrades. A lot of times the numbers do come in lower in the buyer. We throw in more working capital or we throw in something to minimize risk. But those are, yeah, that's on the retrade side for purchase price and things like that.
Okay, we're going to come back to the working capital piece and how the QofE affects the working capital peg. But I want to keep going on the questions here. Zoe's asking, would a seller ever offer up a QofE? It seems like that wouldn't necessarily be trustworthy. Um, kind of house seller offering house inspection, home inspection report from the seller.
Yeah. So we do sell side QVs and it's growing as a practice area for us pretty substantially over the last few years, really to avoid retrades. And I think everybody wants to do that as they go to market. I would say still get the buy side QV done. What all that's going to happen for you as a buy side QV provider and as a buy side QV is you have the data room set up. You should be able to chat with the sell side QV provider, see what they've done, pressure test their assumptions, and makes the process a lot easier for the buy side QV. I would still say get it done, but it just makes the process a lot easier. It makes the process smoother. And honestly, at the end of the day, it prevents you and the seller from having to deal with a lot of issues because we're doing one now where we did a sell side QV and the buy side QV is a little bit different. We talk directly as QV providers, and it keeps the seller and buyer sort of at bay a little bit. And they say, listen, you, the seller QV provider can tell you, and buy side QV provider could tell you. Now, the buy side comes back with something that I think I agree with, I'll go ahead and tell the seller, okay, that's a fine adjustment. We'll work with that. So it's really just, it makes the process easier. But yes, to your point, always get your own QV because there's just going to be inherent bias from a sell side QB provider. Not all the time, but it can
Well,
happen
there's
depending on who
bias
they
on the
are.
buy side too, right? Because
Yeah,
it's the perspective of what the buyer and how the buyer is going to operate the business, and two buyers are going to look at it differently, and that's going to influence their QoE provider to an extent.
absolutely, and that's why the sell side QB is more it's increased in value for the sellers as well because they're protected by somebody like us who will say no, like I know you're trying to push this adjustment, doesn't make any sense, we're not going to go for it. And usually honestly like the buy side QB, if they know there's a sell side QB person there, they'll be a little bit less aggressive on some of those adjustments otherwise the seller wouldn't understand and then they'd have to take at face value.
Yeah. And essentially at that point, both parties have independent financial advice coming in.
Yeah,
It's a little bit easier to
absolutely.
navigate that conversation. Latif is asking the difference between if you could elaborate on a full QofE versus a QofE light, data workbook only versus the full report.
Yeah, absolutely. So I think this kind of goes back to my original point of understanding the definition of QV and QV light because every firm I think is going to have a different definition of what goes inside a QV light. At the end of the day, a QV is a consulting engagement. So each firm's what they do for a QV can change and it will change. Their procedures are different. What they ask for is different. It's just how it is. It's not an audit. So, at the end of the day, it's going to be a little bit different. So my first point to that is make sure you ask your QV provider what their difference of QV and QV Lite is. For us, a QV Lite is just what we do for lower mid markets or ETA type deals where we do the data book only. And we focus on the same procedures we would for full QV. It's just less writing, less narrative. We don't put together a 50-page report for you that's a bit overkill around accounting cycles, control cycles, all that stuff. We focus on the meat of the business and we focus on the actual EBITDA, net working cap, proof of cash, the actual procedures and summaries. And so QV Lite is actually our most popular offering in the lower mid market and ETA space. And then obviously, as you get up market, you have a lot of investors, you have a lot of people on your cap table, you're going to have a significant amount of debt on the business. Then you might want to do a full scope QV just so you have a report. It's easier to read, it's easier to digest, and you can send it off to 50 people without them having to fumble around in Excel. But for a lot of deals that are self-funded or it's just you doing the deal, it's you and maybe one SBA lender, QV Lite is sufficient enough. because you'll understand that Excel because we walk you through that from tab to tab and every single thing on the tab. Which, so for your perspective, if you're self-funded, you're in the ETA space, we always recommend a QofE Lite unless there's a reason not to get that done.
No, that was my follow-on question. I believe you've answered it, but I'm going to ask it again in a different way, just in case there's anything else that triggers it. But what
Sure.
can sometimes trigger the QofE full report? And you kind of mentioned from, the lenders and the investors' perspective, that's when it might be needed. But is there anything else that might trigger the requirement for the full report versus QofE Lite?
Yeah, I don't think anything from like a requirement perspective. I think it's just if you've got a big deal, if you've got complexities, if you need more color around the numbers, if you need more context around the EBITDA adjustments, if you need more context around the P&L, the balance sheet, what the accounts mean, how they flow, the cash conversion cycle, what does it mean that it's 100 days? What does it mean from the DSO side? What are things that change that? So if you just need the narrative a lot more in depth, then I think the PDF makes sense. And I think for a certain deal size, the PDF just makes sense because you have to go out and raise capital from a lot of different people. And then you don't want to walk everybody through the Excel data book every single time because it's just going to be cumbersome. And if the PDF's cleaner, easier to send, it looks more professional. So I think it depends on the deal and your situation. But I would say for most in the ETA, the QV Lite and the data book is fine. And then as you get up mid market, you might want to look at getting a PDF. Or if you've got a complicated deal, it's a carve out. Sometimes in carve outs, I recommend getting a PDF because there's just a lot of things that are happening and a lot of the reasons why we carved out certain numbers, why we didn't carve out others, why we've increased adjustments in areas. So there's just a lot of complexities or something like that.
Good. Kareem, I see your question there. Let me know if Avneet has not exactly answered it yet. I believe he has, but let us know if there's any extra detail that you were looking for there. And his question was around primarily serving lenders and investors. Do they have any requirements that you've seen, or how are they looking, the lenders and investors looking at the QofE? They're expecting kind of a package.
Yeah, I think most investors and lenders are okay with the data book as long as they know what procedures went into it. Again, I caveat that by saying if you get a QofE Lite and someone just sends you a proof of cash, investors and lenders are probably not going to be happy. And they send you a 3-tab Excel with just QofE figures on it, they're probably not going to be happy. So make sure when you're getting a QofE Lite, you understand the deliverable you're getting and making sure it's a robust Excel with a lot of like the actual procedures, the appropriate amount of work done into the appropriate amount of areas. And so if you've done that, I've never seen investors or lenders say, oh, we want a PDF on top of this.
Thanks for that clarification. We always get the question around the numbers. Is there an estimate or ballpark range? You know it can depend on scope of work and complexity of
Yeah.
the business, but is there a ballpark range that you can let folks know about price range for QV or versus a QV Lite?
Yeah, so generally the QV Lite, it's gonna, yeah, like you said, it's gonna depend on the deal and what we're looking at, but it's probably gonna be in maybe US dollars, it's like 10 to 15, and then a QV full scope kind of in that 15 to 20, and that's for ETA sort of lower mid-market transactions.
Thanks for that. It's always a popular question. Feel free to keep these questions rolling, guys. They're fantastic, everyone. But I'll come back to the working capital piece of NEAT. Can you walk us through, normally when an LOI gets paper, there is a working capital peg in there. And then in your work, you're validating whether that peg was accurate, I take it. And walk us through how the QV impacts that working capital peg and what some of the nuances might be with the brokers in arranging that.
Yeah, totally. So the working capital peg is an important part of any QofE, and I think it's one of the areas that ends up being the most controversial, I think, between a buyer and seller. And it's really because the understanding of it differs a lot of times in the lower mid market. Is sellers might not understand why they need to leave working capital. They don't understand why they need to leave AR in inventory and things like that to run the business. And so from our perspective, we always tell people to put something in your LOI around working capital and make sure the seller understands that they're going to have to leave something behind within reason, and we're going to figure out what that is. And so what we do is we obviously look at a working capital peg and we try to find something based on the trailing 12 months or the past 2 years. It really just depends on if the business is growing, shrinking, or stabilizing. What we use is the average. Trailing 12-month peg is usually the most popular average, unless there's a reason for it to be shorter. For example, if the business has seen rapid growth and we're talking 20% maybe month over month or something crazy, then you want to use a shorter term like trailing 3 or 6, because that's more indicative of future operations, and vice versa if the business has been shrinking, etc. And really, from our perspective, in the lower mid market, what we see is things like inventory are wrong a lot of the time. Companies are expensing cost of goods sold through their P&L and not holding inventory in the balance sheet. So usually that's a fairly large adjustment. Deferred revenue is usually a fairly large adjustment. Things like accounts receivable, if there's no bad debt or there's no AR reserves, are usually an adjustment. Payroll accruals are usually an adjustment. And so those are some of the main areas that we see on the balance sheet that are done incorrectly. And the other thing is really is we want we definitionally, working capital means current assets minus current liabilities, but we have to talk about it in the lens of M&A, where we remove debt. So there's no line of credits. We did a deal where the seller got their CPA to do a working capital calculation, and their CPA included all of the debt in the business, lines of credit, and they said, "Oh, we don't have a working capital need because we got $1.5 million in line of credit, and that's reducing our working capital to zero." It's like, okay, no, that's not how this works, right? So I think understanding that a little bit and walking through the nuances of that is always challenging. But really, from our perspective, we just want to make sure you, as a buyer, when you buy the business, you are actually buying a business and not just a skeleton of a business.
Mhm.
You've got the gas to make the thing run, and the seller hasn't stripped it of everything needed and everything inside of it. That's, at the end of the day, what we want to do. And really, people, the working capital true up, which happens post 90 days, where we agree on a peg and we do a true up based on what was left behind in the business, things like that. We always want that true up to come out to zero. The working capital peg isn't about making a buyer win or a seller win. It's really about just finding out what the business needs and
Mhm.
what it's historically needed, and just having that in the business. There's no win or loss in this. We want the scenario to be the business is what it is, and it's just going to keep running as is. So
Yeah.
I think sometimes buyers try to think, or sellers try to think, oh, they're trying to win, or this person is trying to win. Is okay. That's not the goal at the end of the day for us. It's really, we just want both parties to get what's fair, and that's hopefully what's in the business at close, and there's no true up needed 90 days after.
Yeah, it's like the oxygen in the business. You're not just buying
Yeah,
the body of the business. There's the oxygen in there to keep going.
absolutely.
It's interesting. We have a lot of conversations, in the investor community and with the lenders as well. And, the conversation around working capital is, in some conversations it's, over raised, so you've got room for working capital, or you've got some grace for working capital needs, or, make sure there's enough on your line of credit, or you're covering the working capital with enough debt. But in your world, it's let's make sure that the acquisition comes with enough working capital and that it's
So
appropriately calculated.
yeah, 100%. And even businesses that come with enough working capital, there still sometimes needs to be a line of credit that you come with as part of the business based off cycles, right? So that's how we tie our working capital in with our cycles. We have to understand the type of working capital we're getting. What's the lead time to turn that into cash? For example, obviously AR is more liquid than inventory, and things like that. So it's the type of working capital, and really we do both, right? We figure out a working capital peg for you, and then we still do a cash flow to make sure that, hey, even if you get this working capital, your first 60 days still might be tight because of A, B, and C, right? And that's just business to business, it'll change.
Yeah, fantastic. Quick question from Kareem here. What's a data book in your words?
Yeah. So if you like, after the call, you can reach out to me and I could send you an example of what it looks like. But a data book is really the workings of the QofE. It's the actual work done um, when we do our quality of earnings. So it's an Excel with maybe 20 or 30 tabs, and it's got everything on a QofE and net working capital. It's everything you'll see in a QofE report, just in an Excel data book with the raw workings. So it's a little bit more robust to navigate, but it's got a lot more detail than a PDF report might have.
Thanks for that. And we've got a clarifying question here from Colin. Is the working capital included in the purchase price, or does a buyer think of working capital as an addition to the purchase price? Great question.
It should be included in the purchase price, depending on the multiple, depending on if you're using SD, all those things. But it generally from M&A, working capital is included in the purchase price.
We see some LOIs from more Main Street business brokers or lower middle market brokers that have sometimes in their LOI no working capital included.
Is yeah.
What is your rebuttal to that?
I've
Yeah,
never
you know
seen
what?
a sim. I've never seen a sim with working capital calculated in any way,
Yeah.
except
So
inventory, which is, working capital in a different form.
yeah, absolutely. So I was having this conversation with someone yesterday, and they were telling me about the research and the deals they were looking at. And I think they had said they looked at this one, it was like 200K in STE. And I said, you're not getting working capital, 200K STE, likely. They're just going to sell you the business, right? So I think there's a certain dollar, like you said, Liz, Main Street and David, for smaller deals where you just adjust your purchase price accordingly and bring your own working capital. Like that's the way you navigate that. But I do think once you get to a certain dollar range, you just have to have it included because it just doesn't make sense for you to bring your working capital for a business that's doing 1 million in EBITDA or even like 500-600. You probably want working capital. But if they don't want to give you working capital, I would say adjust your purchase price accordingly and just knock it off the purchase price and just say, well, we won't take working capital, but this is the purchase price instead.
Any recommendations when it's a really competitive deal and you're trying to knock down your purchase price for working capital, but there's competing offers that are, or does it get, is that where it happens in the retrade?
Yeah, I think it's always challenging how to navigate those waters. And I think really from our perspective as a QofE provider, we want to make sure you're covered from the working capital stage. So whether it's you're able to bring your own, whether the deal we think is going to need a lot of working capital, or if it's a business that, might be a lot of recurring revenue, no AR, no inventory, okay, maybe you might get away with not having a lot of working capital or any. So, whereas if you got a business that's construction based or you got a business that relies on 3PLs, then okay, you have to have inventory and AR because you're going to run out of money day one.
Hmm.
I think it just depends on the situation. And if you're going through a competitive bid, obviously it's a bit trickier. I would always my preference is to always start with working capital included in the LOI and mention it and talk about it. And then if you want to take it off because it's a really competitive bid, I think that's a case by case situation. And it has to be a business that you really love. And it might make sense that the business doesn't need working capital where you've got a lot of liquidity and you're able to bring your own and you're okay with that. Those are kind of the scenarios that I see playing out.
Okay, thanks for that color there. When it comes to like the SBA requiring a business valuation, what's the difference between, them getting a business valuation done versus a QofE? Can the QofE replace the requirement for a business valuation, or do people still need both when they're going for SBA? How does that work?
The SBA valuation is just it takes the presented numbers by the seller and by the seller's team and values the company based on that. The QRV makes sure those numbers are accurate. So evaluation does not protect you from misstated EBITDA. It's not going to protect you from inaccurate working capital and things like that. It's not doing a deep dive into the business's financials. It's just taking the business's presented numbers and saying, okay, EBITDA is at 1.2. Let's see what the valuation of the business is. So it does not replace a QofE at all, I would say. And they're very different procedures and scenarios. If you do get a QofE, it would depend on your lender if they still want a valuation done. But a QofE is a lot more in depth, takes a lot longer, and really dissects the business from top to bottom. Whereas evaluation just takes the presented numbers and then does evaluation on that.
Okay, thanks for that. And difference between QofE and audit.
Yeah. So an audit is a standard state. An audit is basically a it's an engagement that is the highest level of assurance where a CPA firm is going to sign off on the financial statements saying the financial statements are not materially misstated, and it's based off of governing body standards. You have certain thresholds you need to meet for materiality. You have to do certain procedures. You have to do a lot of the checklists and a lot of the stuff required by the CPA governing bodies. An audit's a lot longer, and an audit is not suited for deal speed and it's not suited for deal scenarios. And what I mean by that is you're not going to have time to complete a whole audit on a small business when you're looking to close. And frankly, a lot of those businesses wouldn't pass an audit. That's why you get a QofE done. The second thing is an audit is going to focus on, did these numbers actually occur? It's not going to focus on any qualitative narrative around the numbers. For example, if you have one customer and that's it, and it made $1 million and you made $1 million, it's going to say, yep, that's right. Whereas a QofE is going to say, oh, that's customer concentration and the margin on this business. It's going to look at other areas. An audit is just going to look at, did this occur? Yes, no. So it's very black and white when it comes to audits. And audits are good for business certain sizes, certain scenarios. Deal speed, SMB, ETA, an audit's just not going to work. You can't get it done quick enough. Most sellers aren't going to pass an audit. So really, you get the QofE done and the QofE is a lot more flexible. You don't have to meet certain thresholds. You can navigate the QofE based on risk. It's more of a consulting engagement, whereas audit's more of a set in stone, black and white. We have to do this, otherwise we're not going to pass this audit, and we're not going to issue the financial statements. So it's a lot different. And I don't think audits are suited at all for SMB and lower mid-market deals because they're just not going to work in the LOI timeline, and a lot of businesses just won't pass them.
Yeah, thank you for that clarification. Kareem is asking, is there a situation where QofE is just simply not a good fit?
I would say no. And the reason for that is any deal, you still want financial diligence done. Now, if your business is so small and maybe you know the seller and you've worked or a lot of times maybe you worked in the business, even then, I still think you probably want to get a QofE. Obviously, I'm biased. I'm a QofE provider, so I'm going to tell you that I've seen horror stories. Like, Liz mentioned, we do over 50 transactions a year. So we see a lot of horror stories and a lot of great ones, but just from what we've seen, I would always recommend getting some financial diligence done or some form of a QofE. If you think your deal is too small for even a QofE light, still have somebody go in there and at least complete a proof of cash, at least do certain procedures of a QofE so you're covered and your bases are covered. At the end of the day, I try to tell people you're buying businesses for millions of dollars. You're 5 years from now, you're never going to think about that 10, 15K you spent on a QofE. But if your business goes bankrupt, you definitely will think about that 10, 15K and think to yourself, why did I not get that done?
Yeah, absolutely. The risk is greater there for sure. And I know you're going to be a little bit biased about this, but how are QofE providers different? And is there anything that people should be specifically asking for when you're evaluating the right QofE provider to work with?
Yeah, absolutely. So I'm going to answer the second part of that question first, is the questions you should be asking. Experience in the industry and the deal size and space you're working on. Make sure they know how to do lower mid-market. Make sure they know how to do ETA. Make sure they're type of deal. Second, ask them for a deliverable before you sign. Like, what are you going to send me? Send me a sample of a previous QofE you've done or a previous deal you've done that you've worked on in the space. Make sure you know what you're getting. 3, make sure they send you a scope of services so you know what procedures they're going to do and how they're going to do it and what years they're going to focus on. 4, make sure you know the team working on your deal. Are they offshoring it? Are they contracting out all of your work to somebody else and just doing a final review? Make sure you know the team. Make sure you know their backgrounds, what their experience is on deals, not just the firms, the actual team. So those are 4 things I think I said. 5, communication. Make sure they're not going to be people that come in there and try to kill your deal. It's got to be somebody who knows how to work with sellers in ETA, knows how to work with sellers in lower mid-market, knows how to navigate brokers, knows how to navigate delays. The relationship aspect about it and the communication aspect about it is probably the most important thing outside of the technical accounting side of the business. So those are the 5 things I would say really stand out to me. I could probably talk about 5 more, but I'm just going to leave it at that for now. And then back to your first questions, what separates QofE providers is really just those 5 things. To start is like, make sure they got experience, make sure you know their backgrounds. and really make sure you know what they're doing and how they're going to be going about it and how they're going to be communicating with you and everybody else involved. And then obviously the main thing is make sure the firm's got the technical ability to do a QV at a high level. And it's not just, we can do QV, sure. We talked to somebody and says, yeah, we did QVs all the time. We did 4 last year. I was like, well, we did 4 last week. So is just difference in level. Like, just make sure you know that is a QV, like a lot of CPA firms say they do QVs. Like just make sure they have like, do they have a dedicated QV practice, or do they do QVs on top of doing 500 tax returns and 10 audits, and now all of a sudden, oh, we could do QVs too, and we could do PPA, and just make sure they're experts in that area and they're not just dabbling in all these different spots. I think that's actually, I'm going to say that's the most important thing before the other things. Make sure that if they do QVs, they actually do QVs, like not just, hey, we've done it in the past.
That's a great point. When we have lawyers in, they often make the example of, when you go to your doctor, you wouldn't go to your GP to get knee surgery.
Yeah,
There are
absolutely.
specialists in these fields, and make sure that they've got the specialization to carry the engagement. Another question here in the chat from Colin. How often would a buyer get a Q of E done and then walk away from the deal if the seller isn't willing to retrade on price, in your experience?
You know what? That's happening on 2 deals we're working on right now.
Mm.
It happens. It sucks. It's unfortunate. The alternative is you overpay for a business, and that sucks, and that's unfortunate. There's no win-win when you get to that stage, really. The goal is you hope the seller agrees with you and is willing to come back around. If not, I think it's a tough decision to walk away, given that you spent money on a QV. But I think it's either you spend money on that QV and you eat it as a dead cost, or you go ahead and spend money on legal QV, all these things, buy the business, and now all of a sudden you have to deal with that business not being what you bought and you overpaid. Not great scenario to find yourselves in, but it's a real scenario and it happens quite often. Like I said, we're dealing with 2 deals where we did the QV and now the buyers are trying to retrade with sellers. I don't know how those conversations are going to go. I don't know if the seller is going to be open to it, but it's a reality. And it's just when you want to get deals done and you work in the deal space, dead deals and dead deal costs and walking away, they're the hardest things to swallow and the hardest pills to swallow, but sometimes it's a necessary one. So I guess that's my point to that.
Yeah, there's a follow-on question to this, and then Colin has a part two
Sure.
to his question, which I'm going to come back to. But in this case, where we're talking about a walkaway situation, are you sharing the report with the seller to validate the retrade? Sorry, not a walkaway.
But yeah, that's up to the buyer. We share the report with you or whoever engages us. If you want us to share with the seller, if you want us to walk through certain sections, walk through our findings, we're an open book. We don't like to gatekeep anything. I don't want to go in there and not tell the seller what we found. I'm not going to preemptively just share it with them without asking the buyer, but it's totally up to the buyer and what their discretion is. Sometimes we'll have a conversation and say, yeah, sure, why don't I share a screen and walk through it with the seller and let's get the seller CPA on board. We did a deal recently where the seller didn't understand why he had to leave deferred revenue back. And I said, listen, I'll share my screen, get the seller CPA. He ended up being ex-Deloitte. He understood deferred revenue. And I said, hey, it doesn't make any sense that you would get this, blah, blah, blah. He's like, yeah, you're right. Talks to the seller. He's like, they're right. We're going to have to leave something behind for deferred revenue. So really it happens. It's totally up to the deal and the deal team and the scenario to figure out in what cases it works.
I love your take on the communication and how transparent you are in the communication. It's because we see a lot where the seller is hesitant to understand these new findings. And so what you're saying is that when you bring in the seller's advisor and you're talking kind of QofE
Yeah,
provider to QofE provider, that's where you can sometimes find the middle ground if the business owner is resistant or not fully
absolutely.
understanding. Okay,
Yeah.
that's fantastic. Okay, coming back to Colin's part two, what's the 1 to 3 things a prospective buyer should do before getting a QofE to avoid having to walk after paying for it? Like if there are things, red flags that they can pick up on the business first before engaging you, things that they can pick up on themselves.
Yeah, absolutely. I think it's always tough pre-LOI to get a full blown analysis on the financials and really understand the nuances. I think early on, just make sure operationally the business makes sense, make sure it's a good fit, make sure. I would say at the LOI stage is hard, but you almost have to take the numbers at face value because you haven't done a deep dive into it. Sometimes it's easy to know when the numbers are wrong, like David was saying. Sometimes they'll have no working capital in the sim. Okay, like you've got a business where your customers pay after 100 days. You're telling me you don't have working capital. It doesn't make sense, right? So there's some red flags you can pick out right away where you know going into it. I'll have to have this conversation with the seller at some point. A lot of times we'll get deals and right away we'll look at the sim and the add backs are crazy. Like we're doing one, we did one and they're trying to add back some, lost revenue for something. And it's like, okay, that just doesn't make sense right away. We did another one where they were adding back, labor. It's just like some things you can pick up right away. It's hard. I would say at the LOI stage, as a prospective buyer, just take the numbers at face value within reason. If the ad backs make sense, the numbers logically flow, maybe obtain the bank statements, take a quick look. Does it make sense? Okay, let us do the deep dive and then post LOI. It's just hard to do it pre LOI, and it's really hard to get all that information from the seller when you don't have that LOI and exclusivity signed. So it's a bit of a challenge to navigate. So I think it's just, rely on your providers to provide that advice for you post LOI, and really let it, it's our job to kind of give you the answer there.
Thanks for that. Any red flags that they can spot early on?
Yeah, I think yes. See, like for example, deferred revenue is usually a big one. If you see that the SIM's got all cash-based accounting and you know there's a deferred revenue component, you can reasonably assume EBITDA's probably overstated a little bit, depending on the area. If you know they're expensing all their inventory through their P&L, you can probably assume there's some inventory in the balance sheet. EBITDA might be understated, but you're gonna have to spend time on that area. Ad backs, like I said, if you see some crazy ad backs right away, okay, probably shouldn't take that at face value. We're gonna have to kind of drop our SD or EBITDA going into the deal based off that ad back. So those are some of the quick high level things you can look at. If the margins seem too good to be true, if you're running a business, you don't see rent doesn't seem to be fair market value. You look at the insurance, it probably doesn't make sense to have the insurance that low for a business of this size, things like that. Labor force, a lot of times you'll see the P&L. Okay, does the labor make sense as a percentage of revenue? Okay, maybe it does. Those are some high level checks we can do. And then year over year growth, if you're seeing crazy growth year over year, always be weary and say, okay, this is probably, something's probably going on here from an earnings perspective. So I think just being aware of those things, and then customer concentration, make sure you're comfortable with that ahead of time. Make sure you can ask about, hey, are there contracts in place with these customers? Understand those dynamics a little bit better. I think those are the big things you can do. And then if you're okay with all of that, I guess let the QB provider do the rest.
Thanks for that. And keep in mind, if you're in the Village Wealth software, you can port in the SIM and the financials, and then you can change, it'll extract all those numbers for you automatically. And then if you do have some difference of opinions on those add backs, you can alter them to see if the deal debt services at a high level before you bring in someone like Avneet as well, just for yourself to do kind of a soft check on it. So keep that in mind with the Village Wealth software. Um, Question from Ryan here. How would you go about a situation where you're diligencing a business and you believe there may have been some shady or less than ideal practices around cash collections? For example, a business where revenue is marketed at 2 million, but the tax return shows significantly less, with the seller claiming the variance is due to underreporting cash revenue. Would you consider this a deal killer, even if the rest of the business is buttoned up?
Yeah, you know what? Anytime there's cash revenue, I say if you can't prove it, I can't comment on it, and I can't advise you as a QofE provider to say that that's real EBITDA and that's real cash because I cannot verify it in any way, shape, or form. That's a completely different situation. That's a situation that's on the buyer to, um, I guess, navigate those waters. But I would always recommend to not include that in revenue and say, listen, if the seller is collecting cash, there's no way to confirm, there's no invoice, we cannot do anything on that because we just don't know. And if you don't know, it's always tough. And I can't give somebody the EBITDA just because they said, yeah, I took 500K cash. You just don't see it. Okay, well then, they could just be saying that. I'm not saying they are, but there's just almost nothing you can do in that scenario.
And
You could
it's
try to reconcile bank statements and try to look at that stuff, but even then, if you can't trace it to an invoice, and if they're not reporting that in their actual business bank account, they're putting into a different personal bank account for cash they're taking, then you're just hooped almost.
yeah. And in a way, they've already reaped the reward of that cash
Yeah,
and
exactly.
trying
The
to have
tax
their cake and eat it too. So
absolutely.
um, can't always win on both sides.
I see it a lot with auto repair shops, but at least auto repair shops have invoices.
Yeah. If they
Hmm.
got invoices,
Yeah.
then we could trace it through. Then it's a lot easier. Auto repair shops, depending on what they use, like we did one. They got like CCC1 is like a pretty good platform or ERP system where we can get access to and trace through. And these a lot of insurance providers, so they got ERP systems for a lot of auto body shops that helps. But yeah, it happens for sure.
Yeah, I've seen situations where vending machine businesses very much cash before it was, tap at the vending
Yeah.
machines, and yeah, there's a lot of loonies collected in those that aren't reported. Um, David, you just have a comment there in the chat. I think you're just commenting on the conversation as
Yeah,
well.
just on the that comment about cash. Because I saw a sim this week where the SDE was the when I got into the financials of it, they were reporting an SDE of 2x what gross revenue was. And the broker's answer was the difference is cash.
Jeez.
Oh,
There's that much gross revenue in
Yeah.
cash, and so therefore the SDE would be higher, except that obviously, yeah. I'm like, okay, walking
That's
away from that
insane.
one.
wow.
There you go. So Liz, you asked me red flags to spot early. There you go. David just answers your
There
question.
you
That's
go.
real.
That would be like a glowing fire
Yeah.
flag. Like red is an understatement there.
At
Um,
least, at least he sent the tax returns to prove it.
yeah, and
It's like,
not
oh,
everyone
look,
would do
gross
that.
revenue on the tax return is this. STE is 2x. No way. Not getting there.
You never know what you're gonna get in this search game. Be prepared for everything. Avneet, we've got just a few minutes left. If anyone is sitting with a question on the edge of their seat, please throw it in the chat. It's not every day we have someone like Avneet here to answer your questions directly, so don't be shy. This is your time. Avneet, is in your mind, is there anything we haven't really covered today that comes up often for you?
No, I love all the questions. Honestly, this was super amazing. I love when people are engaging, and it gets me thinking about things and thinking about things from a buyer's perspective and actual searcher perspective. I think you guys are doing the right thing, having jumping on these calls, asking these questions early, getting ahead of it. I can't tell you how many times searchers go into a deal and they haven't even done any of this stuff. So you guys are already ahead of the ball game. And yeah, and like Liz says, if you guys want to chat with me after, and you guys want any resources from TreeWalk sample reports, data book, I think I was telling someone earlier they could send them that to them. We're always here to share resources and really just whether you hire us or not, just to increase your guys' knowledge of the situation. So when you go into a deal, you understand what you're looking for.
Thank you so much for your generosity and your time
Yeah.
and your resources. We have one question from Na here, which
Sure.
we may have answered already, but that's okay. If the seller
Yeah.
uses unaudited financial statements, would that make the QofE process more complicated? So
I
most
no,
deals in the lower middle market are unaudited.
yeah, I think we've done maybe one deal that had audited statements. um, the one okay on this topic, reviewed financials. You might see those.
Hmm.
I'm a little bit of a stickler on this. I don't think reviewed financials. I think they give such a false sense of security. When you guys see reviewed financials, please don't take them as audited. Please don't take them at face value. Please don't think they replace a QofE. And audited financial statements actually have work done behind them. Reviewed financial statements do not have a lot of work done behind them verifying. So if you guys ever see deals that say reviewed financial statements on them, and they might as well either to get an audit or don't get anything because they're not doing anything for you.
Okay, good to know. Good to know because I had that assumption that the review financials were that, next standard and that you could trust them more. So that's the first time I've ever heard that response. So thank you. That's my
Yeah.
biggest takeaway for today. All right. Last chance, anyone with any questions lingering? No. Okay.
Oh,
Avni.
the one question I
Oh,
saw
go
that
ahead, David.
didn't get answered, and I kind of provided an answer,
Sure.
but in the chat was around like how much should we expect to pay for something like this?
Yeah. So again, yeah, I think it depends deal to deal, but like US dollars, I would say maybe like 10 to 20, depending on the deal and what you're looking at. That's the lower bid market sort of ETA price ranges, I would say. So that's likely what you'll see in the market for most folks.
Thank you.
That's what
And
I've seen.
that's what you're finding too, David, from quotes you're getting. Fantastic. Avneet, what's the best way to reach you, or what's your preferred method of contact?
Yeah, email, LinkedIn. Should I just drop my email in the chat, Liz, or
Yeah, throw
whatever's
it in the
best?
chat, but we will include it in the recording. So
Okay,
we will send out the recording to everyone.
perfect.
Shivani, that answers your question. It will also be available on our YouTube channel. So if anyone is looking for past recordings, we've done sessions with SBA lenders, non-SBA lenders, some of the investment funds in the group. So visit Village Wealth on YouTube. Again, wealth is WELLTH, just for fun. And there, Avneet has his email in the comments there. So thank you for that. But we will include his information in the recording email that goes out as well. So with that, we will release everyone for the day. And thank you for joining us, everyone. Enjoy the rest of your Friday and your weekends. And we'll see you next time.
Thanks,
Thanks for
everybody.
joining us, Avneet. Really
All right.
appreciate
Yep.
the generosity
Thanks,
and
everyone. Thanks, Liz.
sharing. Okay, take care, everybody. Bye for now.
Bye.